Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
Okay, let's get right to it. Looking at the board, as of mid-February 2026, Intuitive Surgical, ticker ISRG, is trading at $485.84. That puts its total market cap at $172.54 billion.
And you can't ignore the context of that number. I mean, this is a violent drop. The stock is down, roughly 18.4% from its highs in early 2025? And just in the last 30 days, we've seen an 11.6% fall. That's a huge move for a company this size.
It is. It's a very sharp retracement.
Exactly, and that right there is the central tension. Is this a fire sale on a best-in-class monopoly that's, just catching its breath? Or is this the moment gravity finally reasserts itself on a stock that has defied valuation norms for decades? I mean, we're talking about a company with a PE ratio of nearly 62, while its own management is guiding for slowing growth. That is a dangerous, dangerous combination.
I get that. On the surface, I do. The optics are ugly. But let me frame it a different way. You call it gravity, I call it a massive market inefficiency. The market is mispricing a transition year. We are standing right at the launch point of the Da Vinci 5, the DB5. And this isn't just swapping old metal for new metal. This is a fundamental shift to a digital data platform. So to look at this dip, which is caused by, short-term tariff worries and a conservative guidance reset, and to walk away from that, that's missing the forest for the trees. This is a company with over $9 billion in cash and a management team so confident they just authorized an almost $8 billion share buyback. This is an entry point.
Okay, but let's look at what you're actually buying with that entry point. You mentioned the buyback, and yes, $7.95 billion is aggressive. But you're buying a company whose management just told you explicitly that procedure growth in 2026 will be between 13 and 15%. Last year, in 2025, that number was 18%. That is a clear, undeniable deceleration. And yet you're still being asked to pay a premium that is triple its peers? You look at Medtronic trading at maybe 16, 17 times earnings, Johnson & Johnson at 22.5. Intuitive is sitting at nearly 62 times. For that kind of multiple, I expect acceleration. I expect hypergrowth. I do not expect a slowdown.
But see, you're comparing apples and oranges. Medtronic and J&J are these huge diversified conglomerates. They sell everything from, Band-Aids to spinal implants. Intuitive is a pure-play technology platform. It has a sticky ecosystem that rivals an Apple or a Microsoft. You just have to look at the revenue mix from Q4 2025. 81% of their revenue was recurring. That's the key. $2.3 billion in a single quarter just from instruments, accessories, and services. They have an installed base of over 11,000 systems. And once those robots are in a hospital, they don't leave. That recurring revenue creates a floor that those other companies just don't have.
That's a compelling argument. I'll give you that. And recurring revenue is, the magic phrase on Wall Street. But have you considered that while the floor might be solid, the ceiling is getting lower? You talk about the ecosystem, but let's talk margins. We're seeing margin compression. Management has guided gross margins down to 67, maybe 68% for 2026. Why? Well, the D5 manufacturing ramp, sure. But more importantly, a 120 basis point headwind from tariffs.
Which is a macro issue, not a company issue.
It affects the bottom line just the same. For anyone listening, a basis point is 0.01%. So we're talking about a 1.2% direct hit to gross margin from tariffs. So you have slowing growth and you have shrinking margins, and you still want me to pay a tech bubble multiple for it?
I just think focusing on a temporary margin dip during a massive product launch is missing the strategic picture. Let's talk about the Da Vinci 5. Because if you don't understand the machine, you don't understand the valuation. This is not just an incremental upgrade. The compute platform on the DB5 has, and this is a staggering number, 10,000 times the processing power of the Shy. It's not just about moving arms, it's about what that power enables. We're talking about force feedback haptics. For the first time, the surgeon can actually feel the tension in the tissue.
Okay, hang on, I'm sorry, but I just don't buy that the compute power alone justifies this. I mean,
10,000 times the processing power sounds great on a marketing slide. But does it change the reimbursement rate? That's the hard economic question. Does a hospital get paid more by Medicare because the robot has a better processor? No. And as for forced feedback, haptics has been the holy grail for years, I know. But is it a nice to have or a need to have? When hospitals are cash-strapped, are they really going to pay a huge premium so the surgeon can feel a little tension when the clinical outcomes on the Z are already excellent?
But it's not about feeling tension just for the sake of it. It's about reducing tissue trauma. If the surgeon feels resistance, they don't pull as hard. Less trauma means faster recovery. Faster recovery gets the patient out of the bed sooner. And we already have proof the market values this. Look at the utilization rates. In the US, the new D5 systems are showing an 11% higher utilization rate than the Xi. Hospitals aren't dumb. They're using the new machines more because they are better. And that compute power, that unlocks case insights. This is the AI play. The system analyzes the surgery, benchmarks performance. It locks the hospital into the intuitive data ecosystem in a way that some modular robot from a competitor never, ever can.
Utilization is up, granted. New toys always get played with first. But let's talk about who's coming for that utilization. For 20 years, Intuitive was the only game in town. That era is over. Medtronic's Hugo is here. It's modular, it's cheaper. Johnson & Johnson's Autiva is looming for 2027. But the real threat, the one the bull case always seems to ignore, is the low end of the market, the good enough competition.
I'm just not convinced. We've heard about the competition is coming for a decade. Medtronic has had delay after delay. J&J's robot is still basically vaporware. And in the meantime, Intuitive still holds, 58% of the global systems market? And, more importantly, 86% of the accessories market. The competition is fighting for scraps.
Okay, then let's talk about China. This is where the competition isn't theoretical, it's state-sponsored. The Chinese market has a quota system. In 2025, there were 90 tenders for these robots. Intuitive won 43, that's 48%. Now that sounds good until you realize they used to win almost all of them. Domestic players like Edge Medical are selling systems for $2 million. Intuitive's average price is $2.5 million. In a price-sensitive, protectionist market, how do you defend that premium forever?
You defend it with quality. Even with the Buy China pressure, winning nearly half the tenders in a rigged market is a testament to the technology. The big tertiary hospitals in Beijing and Shanghai, they still want the Da Vinci. And China isn't the only growth story. Procedure volume outside the US grew 23% last year. The international story is robust.
International is fine, but it's lower margin. And again, you're brushing past the geopolitical risk. That tariff hit is likely just the start. If trade tensions escalate, China doesn't just become a competitive market, it becomes an inaccessible one. And if you take China out of a 10-year growth model, the math for a 5x return starts to look, well, it looks incredibly shaky.
I think you're too focused on the defense. Let's talk offense. New clinical frontiers. The biggest news recently was the FDA clearance in January for cardiac procedures, specifically mitral valve repair. This is huge. Cardiac was the original dream for robotic surgery, and now with the DV5, they're back in the heart. This opens up a whole new high-value market.
Cardiac is a prestige play, but is it a volume play? That's my concern. And while they're pushing into cardiac, they are risking ground in bariatrics. We have to talk about the GLP-1 drugs, Ozempic, Mounjaro.
The weight loss drugs. I knew you'd bring those up.
You have to. Bariatric surgery volumes are softening. It's unavoidable. It's less than 3% of Intuitive's volume now, I'll grant you that. But it signals a secular headwind. If we can treat chronic conditions with an injection, the total market for surgery shrinks.
It's an interesting point, but I think it's overstated. Bariatrics is a tiny slice. The real growth is general surgery, and now, acute care. After-hours acute surgeries on Da Vinci platforms grew 33% last year. That's as essential as it gets. And there was a study in the Annals of Surgery showing robotic patients are 50% less likely to be converted to open surgery. That statistic alone justifies the cost to insurers. That is the moat. It's clinical data.
Clinical data is great, but let's get down to the hard mathematics. This is where I really struggle. The bull thesis is that this is a stock that will 5x in the next 10 years.
Okay, to 5x from today's $172 billion market cap, you need to get to about $862 billion by 2036.
Which is entirely possible. They've delivered a 23% annualized return over the last decade. Why not again?
Past performance, as they say. Look at the requirements. To hit that number, let's say they maintain a very optimistic 18% earnings growth for 10 straight years. You compound their 2025 net income, and you get to about $17.6 billion in earnings in 2036. Well, to get an $862 billion market cap on that, the stock would need to trade at a PE of roughly 49 in 10 years.
And why is that impossible? They're at 61 now.
Because by 2036, Intuitive will be a mature industrial healthcare company. Mature companies do not trade at 50 times earnings. They trade at 20, maybe 25. If that multiple compresses to a normal 25x, even with all that growth, the stock barely doubles. It doesn't 5x. The valuation compression eats all the growth.
I see the math, but your core assumption is wrong. You're valuing them like they're Caterpillar. I'm valuing them as a data platform. With case insights, with the MyIntuitive Plus subscription model, they are building a software margin business on top of the hardware. Tech monopolies deserve tech multiples. The multiple won't compress to 25 because the business model is evolving.
But data is the buzzword every company uses to justify an inflated multiple. Until that digital revenue is a massive, distinct line item on the income statement, it's just speculative. You're paying a 62 times multiple today for a maybe on data monetization tomorrow.
It is not a maybe, and you're forgetting the balance sheet. $9 billion in cash. They can buy growth. They can acquire AI startups. They can shrink the share count. If revenue grows at 15% and they buy back 3 or 4% of the stock every year, earnings per share grows at 19-20%. The math works.
Or aggressive buybacks at near all-time high valuations suggests they don't have better ideas for internal investment. It suggests they're trying to prop up the EPS to mask the slowing top line.
Or it suggests they believe their own stock is the best investment in the market. It signals confidence.
Well, we shall see. As we look at the next 12 months, the rubber really meets the road.
Absolutely. We're all watching the DV5 utilization numbers. That's the metric that matters.
Right. So to wrap this up, when I look at Intuitive at 485, I see a dominant actor in a suddenly very crowded theater. The price is better than it was at 610, I'll give you that. But with growth slowing to that 13 to 15% range and margins getting squeezed, the risk-reward is just incredibly tight. You are betting on a decade of perfect execution to justify this price.
And I see a company that has executed perfectly for 2 decades, giving us a rare entry point. This dip is the opportunity. The transition to the DV5, the cardiac clearance, the fortress balance sheet, it makes us the safest bet in high-growth healthcare. You aren't just buying a robot company, you're buying the operating system for the future of surgery.
So it really comes down to that central question. Are you buying the hardware, which is slowing down, or are you buying the data platform, which has exponential potential but isn't quite proven yet?
The next 12 months will tell us. If DV5 utilization stays high and cardiac starts to gain real traction, the bull case wins.
And if margins slip further or China locks them out, the bear case takes over.
Thank you for listening to this debate on Intuitive Surgical.
We hope this helps you navigate these volatile numbers.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.